So in the last video, I talked about the efficient market hypothesis, and I talked about specifically what it is, defined it, and I applied it to a bag of 1 kg carrots. So the efficient market hypothesis basically suggests that economic actors like me and you, if rational, it also does suggest that we are rational when making decisions to buy things. So if we are rational, if we are rational, we will pay the correct price for items when we're going shopping. So if we're going to the supermarket to buy a 1 kg bag of carrots, if it costs £1, if the value is £1, we'll pay £1 for it. If it's valued, yeah, if the value is £1, we'll pay £1 for it. If you pay less than £1, you're also rational. You're just more rational than the person that pays the exact intrinsic value. If you pay more than £1, you're irrational. But the efficient market hypothesis suggests that economic actors like me and you are rational. This is clearly not the case because you see people buying overpriced items all the time. But in this video, I wanted to redefine, or I wanted to just to go over the definition of the efficient market hypothesis, and I wanted to talk about how it applies to stock prices specifically, and I wanted to talk about whether the stock market and stock prices reflect the efficient market hypothesis. So as I said earlier, in general, the efficient market hypothesis doesn't stand with regards to people paying the correct price for items, because people pay for overpriced items all the time. In the stock market, you see this as well, because stocks like HSBC, there's a lot of other companies. It's rarely the case that a company's shares are priced at the exact price of the intrinsic worth per share. So take for example HSBC. Like I said, the share price right now is between 400 and 550 pence per share. The actual price should be the actual price should be a lot more than that. So if you look at the entire value of the company, the entire value of the company is like, I think it's between 60 and 80 billion dollars or pounds, more valued more than the actual than the actual market cap. The market cap is just the share price multiplied by how many shares that they have. So the actual value and the intrinsic value, the actual value and the market value is completely different. So people are paying the wrong prices for things all the time. So where the efficient market hypothesis, it doesn't. I would say it doesn't stand because people are rarely ever rational when making purchases. But to go over the definition again of the efficient market hypothesis and how it would reflect in the stock market, this is what the stock market would look like, or just in general purchases by economic actors, what it would look like if the efficient market hypothesis were true. So almost instantaneously, if the efficient market hypothesis were true, or if it were to stand, or if it reflected reality, what would happen is, as soon as a new piece of information was released about a particular item or a particular product or anything that can be purchased, as soon as new information is released into the market or released into the world, the all economic actors that are interested in buying that item would have that information, would receive that information, and apply that information to their rational decision making when making a purchase. Take for example stocks of HSBC again, or Lloyds Bank. Let's say Lloyds Bank, stocks of Lloyds Bank. As soon as a balance sheet and an annual report is released, an annual report and a balance sheet are just financial statements that tell the investor or tell the public what the company is up to and how much the company is worth. So if you're an investor, if you're a prospective investor and you're looking for something to invest in, to make a return on investment, you're going to be very interested in these two documents as well as other financial documents, and if the efficient market hypothesis were to reflect reality, you'll definitely be interested in these documents, because you want to realize, what am I investing in? Is this a good investment? And that information will tell you if it's a good investment. If you have the skills to determine whether something is a good investment or a good financial investment based on the numbers, you'll be able to have those questions answered, whether this is a good investment or not. Of course, you need other pieces of information, but those two pieces of documents are paramount. So if the efficient market hypothesis reflected reality, those two pieces of information would be almost instantaneously absorbed by prospective investors, or people that were interested in looking for another investment, or people that were specifically interested in buying shares in Lloyds Bank. And then what will happen after is the market price would almost instantaneously change and adapt to that information. So, say for example, the annual report suggested that the actual intrinsic value of Lloyds Bank has decreased from 69p per share to 60p per share, and the company Lloyds Bank had 100 shares available for the public to buy. So that's about £69 that the company is worth. If the official market hypothesis were to reflect reality, the share price of Lloyds Bank would almost instantaneously, relative to when the information was released, almost instantaneously change from £69 down to £60 to reflect the actual intrinsic value of the company. Of course, this doesn't work because you need to account for fees, you need to account for the whole purpose of a business existing to make profit, so you need to account for that. So the efficient market hypothesis doesn't necessarily, or maybe I need to do more research, or maybe I'll probably do, because it's probably more extensive than that. But from the basis of the definition of what I've received, it's not possible for it to be the case, because businesses have to profit for them to exist. Even non-for-profits have to profit for them to exist. Otherwise, you can't pay your staff, you can't grow, you can't scale up. There's different businesses based on profit, so you can't. So you need to account for fees, you need to account for different expenses, and different monetary needs of the company as well as the consumer. For the efficient market, so the efficient market hypothesis can't stand based on those things. I'm gonna cut the video short because we passed 6 minutes. Thank you for watching. See you in the next one.